Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsb@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to Kaizen Time. I'm joined by Henry, a manager here at Kaizen. How you doing, Henry?
Doing all right. How are you?
I'm doing wonderful. And we are going to be talking about 2024 and basically how to develop a budget. You work in budgeting all the time. That's your bread and butter. So give me the rundown. How to develop a budget for a small business that basically is supporting growth throughout the year. We'll talk specifically the beginning of the year, like what should they be doing in like this Q1 time, and then moving into like Q2.
Well, so the first thing is that there's an issue that you're starting in Q1 for budgeting 2024.
When should this have happened? In an ideal world, when would this have happened?
Usually you kind of start laying the groundwork in the third quarter, and then, as you accumulate data throughout the year for your formal budgeting process, you kind of do some kind of formal planning in the fourth quarter. Usually October, November, because a lot of companies, management tends to take time off for the holidays.
Okay.
So usually, you kind of want to get the thing wrapped up by mid-December. Is a typical timeline. There's also, potentially, depending on how intricate you get on your budgeting process, or how much your business ebbs and flows and changes throughout the year, you might do like what some people might call a quarterly cadence, right? So you did your budget at the end of last year for this year. Typically by the time day one rolls around, your budget's already wrong, right? Like
budgets are optimistic.
We're trying to predict the future here, as we all know. If we were all fortune tellers that worked, we would all be sitting on beaches,
right,
doing absolutely nothing, right?
Predicting the future, right. On the beach.
I mean, you've seen Back to the Future too, right?
Mm-hmm. Yep,
the almanac.
So let me ask you something. So, I mean, people are already, they already have an idea. They kind of have a budget in mind. So I guess let's put it this way. How can they refine that? What are some options they could have to really kind of lock that down, even if they just have a rough one that maybe they put together?
So most of the time people do top-down forecasting, which is, usually what you want to do. You don't want to generate your expenses off of expenses. You want to kind of generate it off what you think your sales pipeline is going to be in the upcoming time period.
So would you say that's like the first step?
So the first step is almost always to budget revenue. Because that kind of flows into, what you can pay for, right? Your revenue helps determine your cash flow, what your expense threshold can be. Can you do any reinvestment projects into your business? Again, sales, you probably spend the most time. The other thing is it's also the biggest part of your P&L, unless you're a losing business.
Did not know that. Can you go into a little bit more depth on that?
Well, so if you think about like how a financial statement or a profit and loss statement is generated, right? It's sales minus expenses equals your op income minus taxes and interest equals your net income, right?
Okay. So
if your top line is not your biggest line, your profit at the end of the year is going to be negative.
All right. That's interesting. I never really thought about it like that.
Not too complicated.
Okay. So what would you say is the best thing they should be doing if they are putting together this plan for the year? Q1 and maybe even for Q2.
So what you want to do is you want to focus the most on your big numbers. So we already touched base on sales. Your next big number is usually anything that goes into either cost of sales or cost of goods, depending on what kind of business you're operating.
Mm-hmm.
Manufacturer will be cost of goods sold. A service company will be cost of sales. So what those costs are all the costs that increase incrementally with your sales or directly tied to your sales. So, for example, your direct labor, your direct materials, if you're in particular, if you're a manufacturer, sometimes depending on what type of business you are, it could include, transportation costs, but anything that is needed to get your product or service to your customer and delivered is kind of your next big bucket, right?
Okay.
And so you want to focus a lot of your time on making sure that you budget those costs correctly.
Okay.
Oh, and that
or take into account any adjustments, because it's a new year. The price of XYZ might go up.
Absolutely.
Right. So making sure that, hey, you do these calculations, everything's taken into account so you can move forward.
Well, so yeah, what you get out of that is, so if component XYZ or widgets is what we tend to go with.
I love that word. I love when you use that word. Sometimes I imagine you go home and talk about widgets.
Not typically.
Did you wash the widgets tonight? We're getting out subject. Sorry.
So if your widget is going to cost 20% more than it did last year, you got to do two things, right? You got to either become more efficient on producing that product, which means either using less labor to produce the same end result, or
adjusting your pricing,
or less material, or you have to adjust your price, because the third avenue means that you're eating away at your margin, which is not typically what you want to do.
The best practice, ideally.
And I know that sounds obvious, but
so really, I guess one of the best steps then is really looking at the numbers, how they've changed, and making sure that you are changing in accordance.
That's the whole purpose, really, of the budget forecasting process. In addition to setting goals for yourself. Mm-hmm. So that's the other thing. We could talk about the numbers here, but you also want to look at what are my goals going into the next year for my business. Do I want to do an expansion on existing brick and mortar, or
do you have a new product line coming out?
Do you want to come out with a new product line? And those are all things that you should include in your budget and forecast, because once the actuals come in, you can compare what you thought and what you came out to, and then you could try and figure out what created that gap. Why is it not what you expected? And make a determination, I need to change my decision-making process and do something differently.
So I want to ask you something, and this may not seem super relevant to developing a budget, but new products, new services, right? It costs something to set them up.
Yeah, so R&D.
Yeah. So my question to you, how do you budget that in? Because it's kind of this unknown. You don't know how much, well, you kind of have an idea how much it's going to cost to get set up, but you don't know what you're going to get out of it. Do you have any tips or suggestions?
Depending on the complexity of what you're getting into, right? So when I was in FP&A, which is financial planning and analysis, you would kind of do a ROI analysis, right? Okay. So you figure out what are all your inputs and what are you hoping to get out of it. It is probably more, it's an educated guess, right? Again, we're
not fortune tellers.
We are all trying to predict the future here. And what you do is, when you're done with that project, are you getting the return that you expected? And if not, why? And is there anything you can do to change it? Or was this just a bad investment? Or are you making more? And what went right? And what are things that you had planned to be costs to this project, whether they are, actual hard dollars or people's time, right? You might have IT, your IT department involved, or your accounting department, or whoever involved in developing this new project that takes away from something else that they can do.
Something, their other profitable activity. Yeah.
We call this opportunity cost. That, you know, it doesn't ever fall on paper, but it's there, right? So you kind of do the analysis, though, to figure out, you know, what should I have done differently? I mean, again, all of this is really striving to reach towards, generally speaking, unless you are on the way out of your business, which there are strategies we can talk about there, but we decided to talk specifically about growth. But you know, it's a continuous improvement strategy, which if I remember correctly, is one of the principles in Kaizen.
That is the goal. That's the goal of this.
So,
one thing I want to ask, Henry, as we kind of wrap this all up, is there anything else that you feel is like an interesting or really useful tip that you would give out for developing a budget?
The biggest thing beyond what we've talked about already is you also want to try and do your best to classify expenses as fixed or variable.
Please explain that.
So your fixed expenses, right? Your rent, maybe your own salary. Trying to think, utilities you're going to pay no matter what.
Basically, something that you can say, this is always going to cost this.
Yes, you're always going to pay it, whether or not your business is operating or not. All your variable expenses are expenses that you incur as a result of running your business.
What's an example of that?
Well, again, like the costs of goods are all generally variable costs.
They could go up on a whim, right?
Yeah, they could go up, they could go down, but they generally flow with the revenue line items. You know, your supplies, any variable staff, right? Like maybe you started your business, it's just you. And you do everything. You're doing the accounting work. You're doing the purchasing. You're doing, you know, sweeping the floor. But now, you know, your business is 10 times what it was, and, you know, you outsource your janitorial. You got someone else doing your accounting. And these are all variable costs that have grown incrementally with your business. And there's kind of a little gray area. There's actually a ton of theoreticals on, you know, true variable costing versus incremental costing. But generally speaking, your variable costs are the costs that go up as your business expands. Okay. Fixed costs is anything that you have to pay for, whether or not your sales are 100,000 or they're zero.
Okay. So what is the big tip to review them, to lock them down?
Well, that's you know, helps you create your budget, right? Okay. Like your building, right? Like you're gonna pay, you know, the $10,000 a month or whatever your rent expense is, or your depreciation, no matter what.
So really, you're saying look at these numbers and make sure that they're kind of taken into account. Basically, look at everything.
That they're kind of flat, whereas your variable expenses should go up and down in conjunction with your revenue.
And you're basically saying that you want to have all these taken into account, basically put them on a spreadsheet or whatever.
Yeah, it's
and be able to compare them on your financial statements.
Well, it's more of a how you kind of calculate the future, right? Like your building cost is going to be $100,000 in the future, whether or not you budgeted $50,000 or $1 million. But your direct labor is going to, in theory, incrementally go up as your sales go up.
All right, perfect. Anything else you want to add, Henry?
It's okay if your budget's wrong. That's what I'll say. Generally speaking, most of the time, day one, like I said earlier in the cast, your budget is wrong the day that you put it in place.
Okay.
And that's okay. That's the whole point of doing the quarterly cadence
Exactly.
And it's
review.
also, again, the real purpose of this and stretch management and all of these things is establishing goals for yourself that you want to achieve in the future. And when you don't get to where you thought you were going to be, you can figure out why and put in place those problem-solving skills to figure out how you close that gap, right? Like if you thought you were going to make $1 million and you only made $100,000,
that would be awful.
What happened that drove that $900,000 variance?
So I guess one thing that I just want to add to this as we wrap up, yes, it is great to develop this budget. And yes, it is great that it's, you could develop it for a year, but it's actually more important that you're looking at these statements on a monthly basis and kind of able to review it.
Absolutely.
And be able to.
That's where the value comes from.
Right. And be able to be kind of flexible, be able to adjust.
Yes.
With these changes. Because as you said, like, let's say labor goes up or a part goes up in price or widget, and all of a sudden now you have to be able to make that work.
You got it. Or, movie writers go on strike or transportation companies go on strike. I mean, these things happen.
They do. And
that you didn't expect.
And that is the world we live in when you rely on outside services too. All right, perfect. Thank you very much, Henry.
You bet.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.